The liquidity bridge myth. What most analysts get wrong about CBDCs, $55 billion in CBDC trades settled on a rail most Western analysts stopped tracking months ago. And it's not because they missed the news. Most of the CBDC conversation is stuck on surveillance and government control, and that's the wrong frame entirely. The real problem is a quadrillion-dollar plumbing issue. You have two banking ledgers that were never designed to talk to each other, and value needs to move between them reliably. The answer isn't one global digital currency. It's something more fractured and more consequential for how settlement actually works. The settlement gap. So here's where the friction actually lives. When a bank in Dubai needs to pay a bank in Hong Kong, the money doesn't move directly. It hops through a chain of correspondent banks, each holding Nostro and Vostro accounts with the next link in the chain. Every bank along that chain needs to pre-fund its position, which means capital sits idle in accounts scattered across time zones and jurisdictions. A bank in London might hold euros in Frankfurt, dollars in New York, and yen in Tokyo, all tied up just to keep the pipes open. That isn't inefficiency by accident. Correspondent banking was built to pre-fund every link, because that's how trust used to work when information couldn't move faster than a telex. At the core of each country's domestic system is a real-time gross settlement system, or RTGS, operated by the central bank. That's where final settlement happens in central bank money. But here's the problem. When you cross a border, you're not in one RTGS anymore. You're in two, maybe three, each running on its own ledger, under its own legal regime, in its own time zone. A payment that's final in London at noon isn't final in New York at the same moment, because the systems don't synchronize. They batch, they clear, and they settle on different schedules. Settlement finality is both a legal concept and an operational one, and a payment is only final when it's irrevocable and unconditional. The payer can't claw it back, and the recipient can rely on it. Operationally, that happens when the central bank's ledger reflects the debit and credit, and the local law recognizes that act is done. But that finality stops at the border. In cross-border trades, you typically have two legs in two currencies, settling in two different RTGS systems. If one leg settles and the other doesn't, one counterparty is exposed. That's Herstatt risk. It's named after a German bank that collapsed in 1974 after taking payment in Deutsche Marks but defaulting before the dollar leg went through. The risk isn't theoretical. It's built into the architecture, which wasn't designed to fail. It was built for a world where information moved slowly and trust required intermediaries at every step. The problem is that the world changed and the architecture didn't. Today, regulators and treasurers are pushing for T+0 settlement. The legacy rails were built for T+2. That gap isn't a delay you can fix with better scheduling. It's a structural mismatch between what the market now demands and what the plumbing can actually deliver. So when people say CBDCs are the answer, we need to be clear about what problem they're actually claiming to solve. The myth of mBridge. Most analysts treat CBDCs as either surveillance tools or speculative moonshots. That frame misses the actual mechanics completely. The deeper myth is that the Bank for International Settlements and the world's central banks are quietly building one neutral, global CBDC platform that will eventually unify everything. If you read the BIS Unified Ledger papers, that's the architectural vision. Tokenized money and assets would coexist on one programmable platform. Atomic settlement would mean all legs of a transaction complete in a single operation, or not at all. Complex multi-party workflows would be encoded in smart contracts. Delivery versus payment for securities, payment versus payment for foreign exchange, and conditional supply chain finance would all happen on the same ledger without waiting for separate systems to reconcile. The vision is appealing because it removes the gap between when an asset moves and when the cash leg settles. Instead of waiting 2 days for a securities transfer to clear against its cash payment, both sides would update in the same instant. Wholesale CBDCs would sit at the center of that platform as the anchor settlement asset. That's not because central banks want to dominate payments. It's because central bank money carries a legal and operational finality that commercial bank money can't match. The central bank's balance sheet is virtually free of credit risk, and its ledger provides clear finality under domestic law. A tokenized deposit from JP Morgan is still a claim on JP Morgan, while a wholesale CBDC is a claim on the Federal Reserve. That distinction is worth making. Retail CBDCs are a separate conversation. They function more like digital cash for the public, and the debate there is genuinely about privacy and banking access. But the liquidity bridge problem is a wholesale problem. It sits between institutions moving large sums across borders, not between you and your coffee shop. So the real competition isn't between CBDCs and Bitcoin, or between CBDCs and stablecoins for retail use. The competition is between CBDCs and correspondent banking as the settlement layer for institutional trades. That's the lens most analysts never pick up, because the retail debate is louder and easier to cover. But here's what the white papers don't advertise. While the BIS was drafting unified ledger blueprints, the live experiments were already diverging into two separate tracks that share no overlapping membership and serve different geopolitical blocs. The live experiment, mBridge and Agorá. The first track is mBridge. It started as a bilateral experiment called Inthanon Lion Rock between the Hong Kong Monetary Authority and the Bank of Thailand back in 2019. By 2024, it had expanded to include the People's Bank of China, the UAE Central Bank, and Saudi Arabia's SAMA, and it reached minimum viable product status. No Western central banks. Since then, mBridge has processed roughly $55.5 billion across more than 4,000 cross-border transactions. About 95% of that volume settled in digital yuan. The platform enables peer-to-peer multi-currency settlement outside the traditional correspondent banking chain. Both legs of a foreign exchange trade settle atomically, so either both complete or neither does. This is payment versus payment on a shared ledger, and it eliminates Herstatt risk in principle because there's no gap between the two legs. Then, on October 31, 2024, the BIS announced it was leaving the project. General Manager Agustín Carstens called it a graduation. The partners were mature enough to run it themselves, and the BIS had completed its hub function. But the framing is too clean to take at face value. 3 months earlier, Vladimir Putin had publicly floated a BRICS bridge based on mBridge architecture as a route around dollar sanctions. At the Santander conference, where Carstens announced the graduation, he was asked whether mBridge could be used by sanctioned states. He replied that mBridge isn't the BRICS bridge, and that the BIS doesn't operate with countries subject to sanctions. That answer tells you what the exit was about. The BIS spent 4 years building a platform that works, then departed 4 months after a sanctioned head of state advertised it as a workaround. The second track is Project Agorá. The BIS launched it in 2024 with 7 G7-aligned central banks and more than 40 private institutions, including JP Morgan, Citi, HSBC, and SWIFT. The design integrates tokenized commercial bank deposits with tokenized wholesale CBDC on a unified ledger, but it routes through the existing institutional structure. SWIFT is a named participant because the messaging layer is being repositioned, not replaced. The dollar stays entrenched as the routing currency, and the incumbent banks keep their role. So mBridge disintermediates correspondent banking. Agorá tokenizes incumbency. They share 0 overlapping central banks, and they aren't parallel experiments. They're competing answers to the same question, sponsored by competing blocs. The era of multilateral CBDC interoperability is already over. Private money, public rails. This block-by-block reality changes how you think about every other form of digital money. Because if there's no single global rail, then private digital money faces the same fragmentation problem the old system does. JPM Coin is a useful example. It moves value inside JP Morgan's institutional network 24 hours a day at speeds the legacy rails can't match. When a client deposits money into a designated account, it's converted one-to-one into JPM coins that can move between institutional accounts inside the bank's own network. Settlement is instant within that closed system, and the credit risk is contained because both sides are JP Morgan clients. But here's the catch. It only works inside JPM Morgan's closed loop. It can't settle a trade with a token on Citi's ledger or a stablecoin on a public blockchain because those systems don't have a common settlement layer. Stablecoins and tokenized deposits face the same boundary. They're programmable and fast, but they still carry counterparty risk or collateral risk. A stablecoin is a claim on the issuer's reserve, and that reserve quality varies widely from one issuer to another. A tokenized deposit is a claim on a commercial bank, which means it carries the bank's credit risk and is only as safe as the bank's balance sheet. Both work well inside their own environments. Neither provides the legal finality that an RTGS system delivers in central bank money, because neither is backed by a sovereign balance sheet. When a trade needs to close between two institutions that don't share the same private network, neither side wants to be the one holding the other's token at the moment something goes wrong. So here's the technical necessity that most people miss. When two private ledgers need to settle with each other, neither side treats the other's token as final. You can't close a trade between Bank A's token and Bank B's token unless both banks agree on what the token represents and who bears the risk if something fails. You need a neutral asset that both sides accept without question. And at the institutional level, that means central bank money. That doesn't mean CBDCs replace private digital money. What it means is that they anchor private tokens to a settlement layer both sides already trust. Without a wholesale CBDC bridge, the tokenized world stays stuck in isolated silos. Each bank, each exchange, each platform operates its own fast internal rail, but they can't talk to each other under the hood. You get speed without reach and programmability without interoperability. The liquidity bridge isn't a luxury feature. It's the structural gap between a collection of fast private networks and an actual interconnected settlement system. How the pieces connect. So, if the future isn't one global CBDC, we need to look at what the map actually shows. There are three layers, not one rail, and the first is block-specific wholesale CBDC corridors, where mBridge is the live example. It connects China, Hong Kong, Thailand, the UAE, and Saudi Arabia on a shared ledger that settles outside the dollar correspondent system. That's not a pilot anymore. It's a production rail, moving real trade volume between some of the largest non-Western economies in the world. The second layer is Western tokenized correspondent rails. Agorá is building this with 7 G7 central banks and dozens of private institutions. The design puts tokenized deposits and wholesale CBDC on the same ledger, but keeps the existing banking structure intact. SWIFT is part of the working group because its messaging layer gets upgraded, not removed. The dollar remains the routing currency, and the incumbents stay in charge. The third layer is bilateral retail instant payment links that need no CBDC at all. India's UPI now connects to Singapore, the UAE, France, and several other countries. Cross-border UPI volume grew from 37,060 transactions in fiscal year 2024 to over 755,000 in fiscal year 2025. ASEAN has linked Thailand's PromptPay, Indonesia's Qris, Singapore's PayNow, and Malaysia's Do It Now into a regional mesh with full regional interoperability targeted soon. Brazil's Pix is following the same model. For a corporate treasury operating across all three, this means one thing. You don't get simpler plumbing. What you get is more rails, each with its own compliance service and settlement logic. No single one of these rails is going to win. The United States just barred the Federal Reserve from issuing a digital dollar until 2030. South Korea paused its CBDC trials because domestic banks started pushing for stablecoins instead. Even the IMF's November 2025 policy paper emphasized that design choices and international coordination remain critical, which is a polite way of saying nobody has agreed on a single standard. This isn't a race to one winner. Countries are racing to avoid being locked out of the corridors that matter to their own jurisdiction. The value won't accrue to any single currency. It will accrue to the messaging standards, the interoperability protocols, and the settlement layers that can operate across competing blocks without requiring a single shared ledger. What this means for your framework. Here's what this means for your framework. The first shift is to stop asking which CBDC wins and start asking which protocols can bridge multiple blocks without forcing every country onto the same ledger. ISO 20022 is the place to watch, because it isn't just a messaging update. It's the data architecture that tells every system exactly what a transaction is and why it happened. That's where standardization actually lives, because it operates across rails that otherwise can't talk to each other. When a payment moves from Agorá to a bilateral instant link, or from mBridge to a domestic RTGS, the message format is what keeps the data intact. The settlement finality signal is also clear. Watch which institutions are moving from pilot to production, not which white papers sound the most ambitious. mBridge is already live with real volume. Agorá is still in testing, with findings expected in the first half of 2026. That gap between live and theoretical matters because the real liquidity bridge isn't a single currency. It's the layer that lets different currencies settle atomically without the two-day correspondent banking delay. If you can't bridge that gap, you don't have interoperability. You just have fast silos. So diversify your focus across the stack. Messaging standards, interoperability protocols, and the assets that are structurally required by the networks they run on. Those are the pieces that earn their value through use, not through narrative expectation. If this kind of structural analysis is useful to you, subscribe. This channel is built for exactly this type of research. The next breakdown covers how to tell whether a token is structurally required by a network or just writing the narrative.